Recently, China announced its big three economic accounts. And Jeff, did they announce the big three economic accounts? The usual
Yes,
ones?
they announced those plus GDP because it's January, so it's the fourth quarter of 2020. Data is in.
And all across Twitter, it was all about how China managed to turn their economy around, how it's the Beijing consensus, no longer the Washington consensus. The communists know how to do capitalism better because their economy grew by 2.9%. Yeah, I guess that's low compared to the recent years, but we had the corona. So they're the only country that really grew strongly or at all. And Jeff, what did you write about in your article?
Well, we're back to the cleanest dirty shirt argument, right? Where that was supposed to be where the United States was for all those years during the aftermath of the 2008 recession. And now all of a sudden the Chinese seem to be very intent upon grabbing the same label for themselves. They had made a major push when they announced these statistics to say exactly what you said. Look at us, we're growing. We didn't suffer a setback in 2020 except for the initial first quarter. Ever since then, we're back on the plus side again. And what's happened amongst Western commentaries that's been extrapolated into only really good things from China in 2021 going forward. And in fact, a lot of the reflationary and even inflationary pulse supposedly in the global economy is derived from how good China is going to be by pulling everyone else out of their COVID malaise too, because the Chinese have figured out a way to manage themselves through this mess. At least that's the narrative, that's the story. Do the statistics actually back up that story? That's really the question. It's true that the Chinese economy grew for full year 2020, but even in the fourth quarter year-over-year rate was just 6.5%, which was up modestly from where it had been in the couple of quarters before, and it was already decelerating its deceleration, its second derivative. So in other words, it was still advancing an accelerating rate, but the level of accelerated acceleration has declined too, which basically says that, okay, 6.5% is not a really good number, because if we can remember just from a couple years ago, even in 2019, where the Chinese growth rates were getting into the 6 and everybody was scratching their heads in anxious worry about what was this going to represent. This is downside stuff. So if 6.5% is sort of what we're going to get out of China, that's a very different story. But a lot of people are saying, oh, 6.5%, that's next year's going to be even better. And so where do we turn? Where do we find answers to this?
Well, first of all, let's mention that I said exactly what the communist propaganda arms did in Beijing, and that gives me hope. Should this YouTube podcast never work out, I can get a job as a spokesman for the communists, and I think that'd be something that I would be proud of, or Mother would be very proud of course. I'm going to have to cut out that joke. She would definitely not be proud of that. Jeff, you were saying, so a lot of people are saying in the press that this is great, but one person who isn't, that's Michael Pettis, who you had been at a conference together a few years ago at the Cayman Investment Forum. And he was on Twitter, and he said that it was driving him nuts, my words, that people were saying that this is a good result in any way. And he said that something along the lines of, like, people are saying this is good, that a good GDP number means the economy in China is good. Know nothing about GDP nor about the economy. And he made the analogy that it's like as if you were taking methamphetamine and then you ran very quickly, and that means you're healthy. He said that the Chinese economy did well, quote unquote, by emphasizing all of the terrible things, by investing in fixed asset infrastructure that they don't need. So more unproductive fixed asset investment. They blew.
Yeah, if you look at the big three Chinese accounts, retail sales in particular, it's not good. In fact, the retail sales growth rate dropped in December from November, having still around what would have been before this last year, among the lowest on record. So Chinese consumer spending hasn't roared back to life at all. It's barely on life support. And so what's happened to give China even just 6.5% growth rate in the fourth quarter is what Mr. Pettis said, which is that the Chinese are doing modest levels of stimulus, modest levels of wasteful spending, trying to get things back moving again. And it only looks good by comparison to everyone else. And so if you are the cleanest dirty shirt and everybody else is completely soiled and muddy and bloody and everything else, then yeah, maybe that sounds like a relatively good situation to be in. But underneath all of that, interpretation, the reality is that China is actually being very sluggish. The economy is coming back slowly. And in many ways, that's going according to their plan. Now, we have talked about this a lot of times. We talked about the 19th Party Congress back in 2017 quite a lot, because in the 19th Party Congress, Xi Jinping in the Chinese Communist upper echelon basically said, China's not going to grow anymore. At least it's not going to grow it the way it used to. And that has all sorts of implications outside of China as well as inside. Now, inside of China, we've talked about and we've documented before this increasing authoritarianism, which is necessary from the perspective of Xi Jinping, because when you turn off economic growth, or you have economic growth turned off for you, that changes the internal political calculations of potentially a dangerous situation with a population that has put up with an awful lot over the last 3 decades, only for the promise of being transported, or their children transported to these glittering new cities and obtaining a middle-class lifestyle. If the communist authorities suddenly say, we're full, no more, what happens to the hundreds of millions of essentially peasants, subsistence farmers, who are left on the outside, have put up with all this crap, and now their government is saying, no more, we're done, this is the way it is. Now you can see why, without sympathizing with Xi Jinping, but you can understand why they're doing what they're doing, which includes cracking down on Hong Kong, because they're enforcing their authoritarian impulse, given the fact that they have announced years ago economic growth paradigm is different in China. And so what we see now of the economy coming out of 2020 is exactly the same thing. They announced, the PBOC in particular, announced what they called a no sharp turn policy, which basically says that, we're here. We've recovered from COVID. This is the recovery. We're at our potential. Therefore, don't expect us to do a hell of a lot more to increase stimulus and to increase growth in 2020, 2021 and moving forward. They're basically consistent with the post-19th Party Congress doctrine of, we're going to get as much growth as we're going to get, and we're just going to try to deal with the fallout. And that's really what they said about the fourth quarter was, this is it. This is 6.5% isn't the first step toward better days. 6.5% is the end. That's the recovery. We've reached potential.
The retail sales numbers that you cited, it reminds me a little bit of the 2008-2009 story, because retail sales are a proxy for consumption, or what share of the economy does the average household have. And by pushing it so low, China was already at surreal levels right now. And so the estimates are that this great recovery was by pushing even further, repressing the households, so that they have consumption will be down like to 40% or something. To just give people an idea, that is a unbelievably low number. A low normal number is like 50%, and most other economies are around 60%. And it just goes to say that the average China. Go ahead, yeah.
No, I was going to say that was the whole point of the post 2011. The idea to restart the Chinese growth under a different model, which was rectifying that situation, right? If consumption is only 50% of GDP, we need to get it up to 60%, which means China was going to grow not from its export sector, because the global growth was completely collapsed. And we talked about that before, the silent depression and lack of upside everywhere else. And so the Chinese said, well, okay, we can't depend on the rest of the world for economic growth. We're going to do it ourselves internally. We're going to rebalance the economy to a more of a consumer-led model. And that never happened either. And in fact, 2020 only exacerbated the difference and exacerbated this disequilibrium, which, as you pointed out, suppressed the proportion of consumer spending even that much more. So even as they tried desperately, it's called dual circulation nowadays, but it's still the same thing. We're going to try to get the internal Chinese economy to make up for what we can't get externally. But even in doing that in 2020 was a complete and utter failure, because they didn't increase the level of internal economic growth. In fact, it was suppressed. It was suppressed by COVID, but as well, not just COVID, but also the economic negative factors and negative pressures that have built up inside the Chinese system too. So it may be that, okay, people are saying 6.5% GDP growth in the fourth quarter is the first step toward better days. The government's saying 6.5% is potential, but given what we see in retail sales and even fixed asset investment on the private side, it may be that 6.5% is actually a sugar high. That might be the best number we'll see in some time. And I know Western expectations are for better 2021, but there are enormous downside risks here, starting with the official position.
It's not a sugar high, it's a black tar heroin high.
I'll trust you to know your drugs.
Oh, I'm not, obviously everyone knows black tar heroin. Oh, okay. So the debt to GDP ratio is expected to go up by 25% this year. That is, bad. Bad is like 15 to 20% increase over a 5-year period. The book I was citing earlier, Richard Vague's A Brief History of Doom. When you see that taking place over a 5-year period, bad. A 1-year period, that's off the charts. That's a black tar heroin high. And I think that 2020 will serve as the pinnacle, as the year that China's GDP as a proportion of global GDP will probably have reached its apex. And I'm expecting to see what we saw with Japan in the 90s and the Soviet Union in the 70s, early 70s, when their economies were booming, just like the United States in the 1920s, booming on an unsustainable industrial policy. And that's, so in your article, you said...
Well, no, what you're saying really backs up the no sharp turns policy, because the Chinese are keenly aware of the financial risks that they're building up by doing these quote unquote stimulus, even modest stimulus. You look at the actual fiscal spending and monetary policy in 2020, and it was nothing compared to even 2016. So the Chinese are very much aware of their financial risk. They don't want to be Japan in 1990. They're trying to avoid that at all cost. And so what you just said, Emil, exactly the reason why they come up with this no sharp turn policy is, look, they want to cut back as much as they possibly can and hope that the real economy grows. And in fact, that's what going back to the 14th 14th 5-year plan that was put forward also recently, they're saying, look, we're in a bad spot. We're going to develop a bunch of new technologies that we can't even describe or even talk about. Hopefully that's going to be the answer. So they've put off any even idea of real economic growth into the future, hoping they can R&D their way to it in the meantime. So they're very much aware of their financial imbalances. And that's really what the authorities have been saying over the last couple of years, is that we're going to try to manage this decline, this lack of economic growth as best we can, and just hope that we can invent stuff to get us out of this fix.
The other of the big three accounts, we got fixed asset investments, so let's call that infrastructure, retail sales, that we'll call that as a proxy for consumption. The other one is industrial production, manufacturing, and I know it's not a great proxy, but I like to think of it as kind of the export sector, manufacturing, and then you ship it out. And recently, the Chinese rang in a great, for them, current account surplus or trade surplus. And that's fine. That's sustainable in a global expansion, not in an economic depression. And it's my understanding that as a percentage of global GDP, the surplus, the trade surplus that China just earned, is one of the 3 biggest in the last 100 years. And Jeff, the other 2 big ones was the United States in the late 1920s and Japan in the early 1990s.
Yeah, those are warning signs, right?
Yeah, this
is an imbalance that's not, you can't depend on this.
Imbalance, that's the word I want to use.
Yeah.
It's not, these are not good numbers, and they're grotesque distortions. There should be a rebalancing that we should see, it's
like when you see a metal or a steel plate that's under pressure or constant motion that starts to develop a crack. That's what this is telling you, that there's a crack in the formation, or a crack in the fundamental foundation of that piece of metal or whatever it is. And what we're talking about here is a key part of the Chinese economic system, not just as it relates to the economy, but also to their monetary needs, which are a constant inflow of dollars. And look at, as we've talked about before, we're already suspicious of the dollar situation in China to begin with, regardless of what CNY is doing against the dollar, because for all that massive merchandise export, the merchandise surplus, where are the dollars? Where are the big money that should be showing up at the PBOC's balance sheet? Where is it? It's safe. What's going on here? And so there's a lot that says that this is as you pointed out, Emil, it's a warning. It's not something you hang your hat on and think about better days ahead.
Jeff, some people say that the dollars that are coming in from this export surplus are showing up on the balance sheets of the private banking system. Would that change your view about the monetary warning signals coming out of China, if that was true?
If that were true, I don't think it is, because I don't see them, certainly not on the balance sheet of the big four. And even if it was true, they would end up at the PBOC too, because remember how the PBOC operates as exchange controls. It's not, the CNY is not freely floating. It sets a limited daily trading band, which requires, if it exceeds that the limits put in place by the PBOC, to step into the market and take those dollars off the market. And so if we saw an excess of dollars flowing into China through merchandise trade as well as financial flows, which would be the bigger flow, we would expect to see the PBOC end up with a big slice of the dollars showing up, or dollars coming in, and they're just not there.
Jeff, before I ask you a final question regarding your article, if there's anything we haven't covered, what do you think at the sum going off script now? What do you think of the appreciating and or strong currency in China? That certainly doesn't seem to be, that doesn't seem to be good for China, right? You've got debt that's exploding higher, and you've got a strengthening currency, and you don't have money expansion internally, right? Because the dollars are not flowing in. I would think you would want more money coming in, a lower currency, to help take the pressure off the debt. Is that something to be worried about? Should I be, am I right to be worried that a strengthening currency isn't healthy for their debt situation?
Well, yeah, that's true in one sense. But look, I think the overriding factor here, at least from the Chinese perspective, is that when the currency goes up, their dollars flow in. So that would be number one. Mm-hmm. And so if you're trying to entice dollars into your economy, what do you have to do? You have to convince the Eurodollar market and the banks that operate within it to lend back into your economy in the way that they haven't been over the last 5-6 years. And so one of the ways you would want to do that is by saying, look, our system is strong enough that we're not going to see persistent problems in the future. We're not going to have economic uncertainty that's going to make you want to pull your dollars out and reduce the currency, right? That's what, whenever we see dollar shortage, that means CNY goes down against the dollar. And so they're really trying to convince the Eurodollar market, hey, look, everything's fine in China. Look at the currency going up. It's a signal that whatever's going on in the rest of the world is good here. At least it's relatively better. It's the cleanest dirty shirt in China. Therefore, bring your dollars back because everything is better here than any place else. And it's the same exact kind of thing that we talked about before. It's the same exact kind of thing we saw in 2017 where CNY's currency went up and we couldn't, there really wasn't a whole lot of basis for it. And it was the Chinese authorities saying, just bring your dollars here. And so what we have in 2021 is we have a strong CY currency, but a sort of I don't want to say a mystery, but an unfilled in picture of why that is and where it's actually coming from.
Jeff, any final thoughts on this article or anything in general that you wanted to share with the audience?
I think it's about the story, the narrative that we're 2021 is going to be this inflationary, really good upside. That everything is moving in the right direction. Everything is falling in line with the favorable inflationary positive column, including vaccines, including government stimulus all throughout the world, and central banks doing even more, whatever it is. And the fact of the matter is, we ended 2020 in a shape that even going back to May or June of last year, we never thought we would be in. First of all, May when things were reopening, it was widely believed that there would be a V-shaped recovery and everything would be easy and we'd get right back to normal. That hasn't been anywhere near close to that. So we ended 2020 in really, and again, the Chinese numbers are representative of this. We ended last year in probably worse shape than anybody had imagined. And so there was all of those things that happened in 2020 that are going to happen again in 2021 to lead to a different outcome. That's really the question. I think it's really, people should be wondering why doing the same things this year will eventually create what it didn't last year.
All right. Thank you, Jeff. Let's do it again soon.
All right. Take care, Emil.
Woohoo! Oops.